You're listening to KSG Podcast. This is a short, crisp, concise, exam oriented, edited editorial for civil services aspirants. In this podcast, we are going to talk about banks' role in financial crisis. Source for the content is Udit Mishra's article for the Indian Express. The Sveriges Riksbank Prize in Economic Sciences in memory of Alfred Nobel for 2022, popularly called the Nobel Prize for Economics, has been awarded to three US based economists: Ben S. Bernanke, former chair of the US Federal Reserve and currently associated with the Brookings Institution in Washington, D.C., Douglas W. Diamond, University of Chicago, and Philip H. Dybvig, Washington University in St. Louis. The award carries a prize money of 10 million Swedish kronor, roughly 7.31 crore rupees, to be shared equally between the laureates. Now, why have they won the Nobel? The Royal Swedish Academy of Sciences, which adjudicates the award, stated that this year's laureates have significantly improved our understanding of the role of banks in the economy, particularly during financial crisis. An important finding in their research is why avoiding bank collapses is vital. This research dates back to the early 1980s. Bernanke on what caused the Great Depression. Now let's tell you what Bernanke said on what caused the Great Depression. The work for which Bernanke is being recognized was formulated in an article in 1983 which analyzed the Great Depression of the 1930s. Between January 1930 and March 1933, US industrial production fell by 46% and unemployment rose to 25%. The crisis spread like wildfire, resulting in a deep downturn in much of the world, from Great Britain, where unemployment increased to 25%, and Germany and Australia, where almost one third of the workforce was out of jobs, to Chile, where national income fell by 33% between 1929 and 1932. The Academy noted everywhere banks collapsed, people were forced to leave their homes, and widespread starvation occurred even in relatively rich countries. Until Bernanke's paper, bank failures were seen as a consequence of the financial crisis. But Bernanke's 1983 paper proved it was exactly the opposite. Bank failures were the cause of the financial crisis. The Academy stated, and I quote, using a combination of historical sources and statistical methods, his analysis showed which factors were important in the drop in GDP. He found that factors that were directly linked to failing banks accounted for the lion's share of the downturn. Unquote. Bernanke zeroed in on bank runs as the key reason why a fairly normal recession spiraled into the greatest economic crisis in modern history. Bank runs happen when depositors become worried about the bank's survival and rush to withdraw their savings. If enough people do this simultaneously, the bank's reserves cannot cover all the withdrawals and it is driven to bankruptcy. Thanks to bank runs, the recession of 1929 had turned into a full-fledged banking crisis by 1930 as half the banks were bankrupt. The Academy remarked that Bernanke demonstrated that the economy did not start to recover until the state finally implemented powerful measures to prevent additional bank panics. The deposit insurance provisions, where a certain amount of one's deposits in a bank are insured, is a critical tool towards building trust and preventing bank runs. Today, Bernanke's views letting banks fail often worsens a financial crisis. Our conventional wisdom, the deposit insurance provisions, where a certain amount of one's deposits in a bank are insured, is a critical tool towards building trust and preventing bank runs. Today, Bernanke's views, letting banks fail often worsens a financial crisis, are conventional wisdom backed empirical studies. Now, talking about Diamond and Dybvig's analysis, since the global financial crisis of 2008, banks have lost their sheen in the public eye. They're often seen as money grabbing institutions that exist to profit off borrowers as well as depositors. But in a world without banks, it would be impossible to make any long term investment. That's because, as Diamond and Dybvig's 1983 paper showed, there are fundamental conflicts between the needs of savers and investors. Savers always want access to at least some part of their savings for unexpected use. This is also called the need for liquidity. They want the ability to pull out money when they need it. The borrowers, especially those taking out a loan for building a home or building a road, need the money for a much longer time. Borrowers cannot function if the money can be demanded back at a short notice. Now, how does society resolve this mismatch? Diamond and Dybvig showed that these mismatches can be best solved by institutions constructed exactly like banks. The Academy states in an article from 1983, Diamond and Dybvig develop a theoretical model that explains how banks create liquidity for savers while borrowers can access long term financing. They've also explained that banks are able to resolve this conflict through the process of maturity transformation. The Academy stated the bank's assets have a long maturity because it promises borrowers that they will not need to pay back their loans early. On the other hand, the bank's liabilities have a short maturity. Depositors can access their money whenever they want. The bank is an intermediary that transforms assets with long maturity into bank accounts with short maturity. This is usually called maturity transformation. Now, together, the work for which Banang, Tabvik, and Diamond have been recognized has also laid the foundation for modern bank regulations. Their work has been crucial to subsequent research that has enhanced our understanding of banks, bank regulation, banking crisis, and how financial crisis should be managed, states the Academy. That's it for this podcast. Thank you so much for listening. To join KSJ India courses and to crack the IELTS exam, visit ksjindia.com. You can also get a PDF of this podcast on ksjindia.com. Thanks for listening and do subscribe to our channel.